The Fed just cut rates and QE could follow. This combo can lift markets. Lower borrowing costs shift risk, and this is good for some while tricky for others. You've heard the Fed cut rates, right? Now what does that mean? Let's find out. Let's go. The Fed just cut rates, and QE could follow. This combo affects the economy and can lift its markets. Here's how. A rate cut lowers the federal funds rate. Federal funds rate implies to interest banks charge each other overnight. Now borrowing gets cheaper. Credit cards, auto loans, mortgages, business loans. Why cut now? You ask. Because growth looks softer. Unemployment risks can creep up. Inflation's cooling. And financial conditions are too tight. The goal is simple. Keep money moving. Spending, hiring, investing. But what if cuts aren't enough? That's when quantitative easing, QE, steps in. QE means the Fed creating money electronically. Buys treasuries. Buys mortgage-backed securities. QE pushes long-term rates down. QE pumps liquidity into the system. QE nudges banks and investors to lend, invest, and take risk. Think. Rate cuts equals ease the gas pedal. QE equals turning on turbo. Quick comparison. Rate cuts equals lower short-term borrowing costs. Moderate push. QE means stimulate the whole financial system. Powerful push. Usually saved for crises or major slowdowns. What this means for the economy right now. Cheaper loans can boost spending. Businesses may borrow to expand and hire. Housing often perks up. Confidence can improve. Risks are risky. Too much juice can overheat assets, stoke inflation later, and tempt excessive risk-taking. For investors, here's the playbook. Stocks. Generally bullish. Lower rates make stocks look better than bonds. Growth names often get a tailwind. Dividends can shine when yields fall. Bonds. Existing bonds usually rise as yields drop. New bonds pay less. Duration matters. Real estate. Mortgage rates tend to fall. Affordability improves. Prices can climb. Crypto and risk assets. More liquidity often boosts speculative appetite. Volatility cuts both ways. Cash. Savings yields fall. Great for flexibility, not for long-term purchasing power. Who tends to benefit most? Borrowers, growth companies, stock investors, real estate investors, and governments with cheaper debt service.